Hello and welcome. Today we are in conversation with Rahul Bhagat. He's CEO of DSP Pension Fund, and with over 2 decades of experience, Rahul is here to share his insights on building a winning pension portfolio and how to make the most of your NPS investment. So stay tuned as we dive into the key strategies that have led to standout performance at DSP Pension Fund. Welcome, Rahul.
Thank you. Thank you so much for having me.
Great to have you here. To begin this interview with, can you share with us, with over 2 decades of experience across insurance, investments, and now pension fund management, how have your stints at ICICI Pru and Birla Sun Life influenced your vision and execution at DSP Pension Fund?
I started my career with insurance, and slowly, steadily, it became more focused towards pension. And before I joined DSP, I was the business head with ICICI Prudential Pension Funds, where I set up. This was the second innings for ICICI Pru Pension, where they had taken a backseat some time back and they wanted to restart the business. And that is when I joined as the business head and the picked up pace both in terms of market share and as well as accumulating the assets. I think whatever learnings I had in terms of my interactions with the customers as well as fund managers, as we used to engage with a lot of institutional clients back then, both in Birla and ICICI Prudential, and that helped me, set up the business and the investment strategies for the DSP. Means all the good work I had, all the things I've learned at both Birla Sun Life and ICICI Prudential helped me, set up the business at DSP and what we have done today. It has definitely because of that.
So for investors trying to choose between the NPS and the mutual funds, what are the key differences in structure, flexibility, and the return potential, particularly with the NPS equity schemes?
Uh, NPS serves a very, very different purpose, and to compare it with equity mutual funds is, I would say, comparing apples and oranges. Though, yes, both are investing in equity markets, but the NPS is purely a retirement fund. When investors are coming, they are coming for the long term and not for the short term because retirement is, for some, it is 10 years, 20 years, 30 years down the line. It is not immediate. Uh, when you're investing in mutual funds, you're doing it for multiple purposes. It could be short term, long term, liquidity, building your wealth. So first of all, I would not like to compare both NPS as well as equity. But yes, though the asset class is same, there are differences. NPS being long term in nature, when the fund managers are investing in retirement funds, he has to really look at long term and not short term. If you compare it with mutual funds fund manager, you ask him what is long term, he will say 3 to 5 years. If you ask a retirement fund or a pension fund manager, he would say 10 to 15 years is long term, right? So the strategy of way we invest is very, very different than how it is invested in equity. But if you look at the framework, is has to be very, very similar in the sense that you want to protect the downside, you want to give the best of returns to the customer, you want to generate alpha, customers want to actively manage portfolio. So all these ingredients which a customer or an investor wants from any equity fund manager, we as a pension fund are also able to give those. But my horizon of investments in terms of long term is 10 to 15 years and not short term. When you look at NPS as a product, as I said, it's long in nature. So the way the product is designed, it has liquidity is not as much as is there in mutual funds, and that is the best part about this product because it is purely for your retirement and not for your other needs. So it is long term in nature, and that's why the regulator has made it restrictive in nature for you to withdraw funds. Having said that, can customers withdraw or the investors withdraw funds? Yes, they can. There are certain scenarios, for example, if they have medical needs, if they need money for some emergency. So there are some classified, clearly written down rules under which you can withdraw money from NPS, like you can withdraw money from your PF, you can do that. Similarly in NPS. If I don't know if I've missed some part of your question, I can address it again. But broadly, these are the things I could relate to.
So NPS offers both active and auto choice for asset allocation. According to you, how should investors evaluate which option is better suited for their retirement goal?
See, it all depends on what are your needs. A lot of customers who are savvy with terms of market and understand the nuances of the market better, they can choose active portfolio. People who don't understand, what should be the right asset allocation, and who don't understand or doesn't have the time to change their portfolio over a period of time, depending on the market situation, I would say auto allocation is the right choice. Within that, we also have today a balance fund, which is a new fund which has been between auto and active, where uh, the only difference between auto and balance is the allocation of equity decreases not from 35 but at a later age. Because what happens in asset allocation is today, if you start with an aggressive option, your equity component starts decreasing from age 35 till the time you reach toward your retirement. So it's an auto allocation, and automatically more of the money is getting towards debt, and your equity components slowly, steadily gets reduced from age 35. Now, there was a lot of need or want from the customers who said that's an early age. This is when a balanced life cycle fund was started by a regulator, and in which the regulator says, okay, this rebalancing will happen at a later age and not 35. So I would propose now a lot of people who are looking at auto allocation should also look at balance fund, because that's a great option. But as I said, between the two, it's totally depend on what's your outlook of the market. Do you have the time and understanding of the market to take those calls for your portfolio? If not, then you can choose auto allocation. In auto allocation, you also have aggressive, balance, and conservative fund, depending on what you want and what your comfort risk appetite is. Based on that, you can choose.
Rahul, for the benefits of our user, can you just in a very briefly explain about this equity, corporate, and the balance kind of schemes, particularly the NPS?
There are four asset classes under NPS. Equity, we have government bonds, and then we have corporate bonds, and then we have alternate assets. In equity, a customer or an investor can go as high as 75%. Uh, both in government bonds and corporate bonds, he can go up to 100%. And in alternate assets, only 5% exposure is allowed because they are risky investments. It's a new kind of asset class, and the regulator doesn't want customers to have an overexposure in those kind of investments.
Rahul, now coming to, can you share your investment philosophy, particularly in managing the equity portion of the NPS portfolio?
We have a value investing philosophy wherein we are very, very selective of stocks at what price we buy. So the valuation plays a very, very critical role in picking those stocks. And if you see today, though it's actively managed, we only have 29 stocks of the BSE 200 index, which we can choose from, right? So out of 200 stocks, we invested only in 29 stocks because of the markets are overly priced, and to get the stock at the right price or at the right valuation is very, very tricky. And we are very choosy and we have a lot of patience about it. So that's our investment philosophy. To simply put, we invest only in businesses which are cash generating over a period of long term, clean management, uh, not overly leveraged, means they don't have high debts. Only few companies of the total portfolio, 3 to 4% of portfolio, have debt on their books. So otherwise, they are free of debt. We buy them at a right price, and we don't pay. We don't pay if the valuations are higher. Given these, so the management needs to be clean, uh, cash generating companies, uh, fair price of the stock, and that is where we choose those companies in the portfolio. That's why you see only 29 stocks of the BSE 200. And because of this reason, why our returns are where we are today as compared to others.
Right. So you spoke about returns. The DSP Pension Equity Fund, it has delivered standout returns within the NPS universe. So what are the key investment decisions or portfolio characteristics that have driven this performance over the past year? You did mention only 29 stocks and these parameters, but apart from that, what is it that has led to this performance? If you can elaborate on that.
The selection is very critical. We also have cash. We sit on, if you look at it, our cash component is as high as anything from 9.5%. The regulatory limit is 10%. So we are close to that. We're always on cash because we are looking at the right opportunities, and markets will always give you right opportunities. Though cash has also led to a drawdown when markets rise, and we are sitting on cash, that impacts our performance. But this is a conscious call because we want to protect the downside, and we are always looking at the if you get some deals in the market which are great but come at a great price too. Now that has helped us, plus our stock selection. I think, and stock selection at the right valuation, not paying significantly higher price just because market is at where it is. We will not jump into and enter those stocks. I think these are the two main reasons why our performance is where it is.
Rahul, just wanted to understand on the equity further on the equity performance. You spoke about that you have invested in 28 kind of stocks. So could you just help us with some kind of sectoral allocation, or are you sector agnostics in managing the equity portion?
We are totally sector agnostic. We don't have sectoral bets in our portfolio. That's not our financial philosophy. Out of the 200 stocks, what we look at is, how many companies don't have a debt exposure. First of all, then clean management. Now, if you put these parameters, you'll be left with few companies. Of these few companies, do you think is the company generating enough cash or has generated enough cash over the period of last few years, right? Then that's the third cutoff for me. Balance is then after I get a list of stocks, we see what is the fair valuation, and we pick the price given at that point of time when we're investing. So that leaves us with a very small opportunity of picking the stocks, and that is also protects the downside when markets fall. And in fact, our downside protection ratio is much higher than our upside ratio. Means when markets fall by 10%, we will fall somewhere around 5 to 6%. And when markets go up by 10%, we might go up by 9.5%. So that is the design of the portfolio, that it protects the downside more than the upside.
Rahul, another thing I just wanted to understand, you have not looked at, but going forward, will you be looking at the growth stocks like the newer tech companies or the defense stocks or that kind of particular companies going forward in the portfolio?
See, as I said, we are always open to the right set of companies, whether it's in defense or new tech. We are totally agnostic. We will pick up the companies which fit in our framework of value investing, and we'll only invest in those and none of the other companies.
Now, Rahul, as a relatively new pension fund manager, how did you go about building the equity portfolio from scratch, especially when competing with the incumbents who has a multi-year track record?
See, that was a tough one, and I think our CIO, Ramneek, has done a phenomenal job. The credit is completely his. When we started, the inflows was not as what they are today, and they were slow because you're new into the business. The investors don't know you, and you're a new fund manager. The fund performance, you don't have the track record of the fund performance, and the money which is coming also at a very low pace. Now, given that whatever money we got in, we were very clear that we'll have a clear value investing philosophy, and we picked only those stocks which were fitting into it, and we stick to our philosophy. We have patience and perseverance to sit on cash, and when the right opportunity comes, invest in, and slowly, gradually, the fund performance became better. The investors' confidence increased, and the inflow increased over a period of time. And when the inflow increased, with the same philosophy of what we had set up from day one, we started just replicating our framework to make sure that we can give good returns to our customers over a period of time. Though 1 year fund performance is not a long track, so we are like 1.5 years now. It's not a great track record, but what we want our investors to believe in, that how closely we mirror our investment framework and how do we follow it. Though there will be times when we will also underperform. Though the markets have been very kind and it has supported our framework, but it will not be the case every point of time. There will be times when investment framework will not work. When markets really rally, it impacts especially the this framework, and there will be time when we will face those challenges. So my request is, don't consider us for last 1.5 year performance. Look at our investment framework, look at investment philosophy, and if it resonates with you and you think this is the right way of approach, then only invest in us. Otherwise, please don't invest with us.
As you consistently mentioned about following a value-oriented framework, so what does the value mean to you in the context of the long-term retirement investing?
See, it's very, very simple in a way. When I'm picking up a stock, I'm actually buying a business, nothing else. At what price I'm going to buy that business? And today, suppose the the share price is 100. Do I value it at 100 or do I value it at 80? Right? So,
Yep.
so for example, today, defense stocks at a certain point of time, capital goods were the flavor of the market and they were at a very, very high valuation. We never invested in those stocks and we are also still not invested. Today, if you look at, IT stocks, it was pretty undervalued given, with the AI thing coming in, a lot of people, we picked those stocks. There was a time last year when banking stocks was undervalued. We picked that IT stock, sorry, the banking stock, both whether it's HDFC or Kotak, it's part of a portfolio. It's roughly around 8% of the total portfolio. So we are always in lookout for the right valuations. And if the markets give those opportunities, and when the opportunities come, we go full hog and buy those businesses.
Rahul, going forward, if we see a scenario where the AUM rises of the fund, do you foresee this considered strategy of around 20 to 30 stocks going up the number of stocks in the portfolio?
It can go up given that I get the opportunity to invest in those stocks at the right price, which we feel should be for the stock at given point of time. And if the markets give those opportunities, we will enter those stocks. If not, then we'll not.
So how do you collaborate with the DSP Mutual Funds equity team and leverage the internal research and your investment processes?
See, broadly, what we look at is the risk framework. We have, a very, thin line between how do we collaborate. We collaborate more on the risk profile and the broader contours so for example, we have a red list of stocks at a group level, which we'll not invest in, right, from the risk framework. So we'll have a very strong risk framework for across the companies, whether it's DSP, asset management company. So, and so is our, based on those risk framework. So we carry those policies more rather than, other things, which we take from our group company or the parent company and implement when we started investing and how we move forward than anything else. Our CIO has his own thought process, and maybe the investment equity team there would have their own thought process. What I would say is DSP Mutual Fund is more evolved in terms of markets, because there they have a huge, they can invest in the international market, they can invest in large cap, mid cap, small caps. They have passive funds, active funds. We are not as evolved as them, and we take the best practices and the risk framework and the broad contours, and based on that we invest.
Rahul, how big is your team, research team, and the fund managers? Could you just put a light on that?
We today, as a very small team, we are a team of only two people. One is the equity fund manager and one is the debt fund manager. They do their own research. We get some research reports from our brokers who keep sharing with them. As we move forward, today we are close to 4,500 crores of assets. As we move forward, we will build our robust research team and deploy more people, given that it's a very thin margin product. We get only 9 paisa today, right? And it's a very thin balance which you have to maintain between the cost what you incur and the profitability, right? Because we also have a target to be profitable over a period of time. So it's a bit tricky. That's why we are conservative, or I won't say conservative, we are very, very cautious of how many resources we are adding to our team. And as our business will support in terms of expenses, that is where we'll also build our research team and a robust team in terms of investment.
Now, for someone investing in NPS for the first time, what should they look for when they're choosing a pension fund manager?
Very good question. A lot of people don't look at it. People also just look at AUM. AUM size is nowhere denominates how good or bad the fund manager is. What you should look at is what is the investment framework. You look at the portfolio, uh, and 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 are the companies talking about what is their investment strategy, how they're going to invest in. Yes, a lot of people look at fund performance. Yes, it helps you evaluate a fund performance of a fund manager over a long period of time. So that is one of the indicators, but that's not going to ensure that he's going to perform better in the future. Broadly, I think you should align yourself where the fund management philosophy aligns with your risk framework philosophy, and that is where the best marriage happens, or the commonalities there is where you should invest in. But I would also say that very few fund managers today are talking about the investment philosophy. We are the first among the PFM space where we are publishing a fact sheet. It's out in the open. We are talking about our investment framework. Our CI is also writing half yearly investment note on how did we do it. So I would suggest the investors to please go through it. And once you think that this is the right framework, and that is only you choose to invest with us.
Rahul, now, what policy changes or the regulatory interventions would you suggest to boost the NPS participation?
Oh, a lot of things could be done. See, as of today, if you look at it, in the private sector, one is the retail customers, citizen of India, and the other is the corporate sector where people like you and me who are employed with companies are contributing to NPS. I think today, as of now, roughly 21,000 corporates have registered for NPS. But if you look at the employees who are with them, how many of them have taken NPS? The takeoff rate is not more than 7-8% of the entire base of these corporates, right? Why? The reasons are many. Onboarding is a challenge because KYC is done again. Can we simplify it? So, and since the product is a low margin, a lot of people are not going and talking about it. If you look at insurance, the margins are great for banks. If you look at mutual funds again, and when you go to them, they're saying it's a low margin product. I don't get anything out of it. So a lot of distributors who could distribute this product are not distributing the product. As long as the margins, distribution margins increase, I won't say they should be aligned to insurance or mutual fund, but there has to be right balance between low cost and some cost, which can help the distributors to actually distribute. So if you look at today, mutual fund distributors are not selling NPS, banks are not selling NPS. Why? Because there are no margins for them. And most of these people are looking at third party, especially the banks are looking at third party incomes coming from third party products, and NPS is a third party product. So having said that, I think somewhere the regulator has to look at the overall fee structure for the fund managers to get the right set of resources, whether it's technology or manpower, to get in and give you the, if you're looking at active fund management, the fund managers don't come cheap. They come at a cost. So does the technology, so does the processes, and as you put in the right set of people, they come at a right set of cost. Similarly, on the distribution side, lots needs to be done. From the distribution setup, can we look at some of the bottlenecks to be removed in terms of KYC, in terms of other servicing aspect, and also the marketing aspect, right? How many people are talking about NPS in the market? Though it is one of the best products, but many people are not talking. So I think these are the certain things which, if the regulator does something about it, can really help take off, and it will go to the next level. See, though we still think that it's at a nascent stage, but today also NPS is like what today? Roughly 14-15 lakh crore of industry, right? Can it be not be 50 lakh crore? It can be easily. But a lot needs to be done to improve the processes, KYC, marketing, for which you need cost, you need to support the distributors. All that is required to take it to the next level.
But then the cost will increase for the investors as well. If all these things goes up, then of course
it will, but as I said, if a fund manager is smart, he can generate better alpha. Now, whether I want a passive fund manager who's not doing anything. So if you look at today also, I was looking at some data. If I look at it, our YTD performance, we have given close to some 8% return. And the I'm not naming the worst fund manager, he's at close to 2% return, right? So there's a 600 basis point difference. And would you look at a cost of going up by 25-30 basis point versus the return? I think it's rather put that cost and get that return.
Well, with that, time for us to wrap up this chat. Thank you, Rahul, for sharing valuable insights with us today.
Thank you so much for having me and giving this opportunity. Thank you so much.
It was great having you. Thank you.
Thank you.
As we wrap up, remember that making informed decisions about your pension fund can set the foundation for a secure retirement. So stay tuned for more expert perspectives on navigating the world of investments and ensuring your financial future is in good hands.